investment bank Credit Suisse said it would borrow up to $54 billion from the Swiss central bank to shore up liquidity and support investor confidence after a flash crash in its shares intensified fears about a global banking crisis. The loan announcement seems to have worked as the shares of Swiss banks soared as much as 30% in today's morning trade. What's more, the Swiss National Bank and the Swiss Financial Market Supervisory Authority yesterday said that the investment bank meets the capital and liquidity requirements imposed on systematically important banks, further dousing fears of a systemic failure. Now remember, shares of Credit Suisse plunged as much as 20% on Wednesday to hit a fresh all-time low after its biggest backer, the Saudi National Bank, said it would not provide further financial support to the bank. Even though it sees Credit Suisse as a strong bank, it is happy with its turnaround plan. The crash in the stock began earlier this week after Credit Suisse said it had found, and I quote, material weaknesses in its financial reporting processes in 2021 and 22. Following Credit Suisse's shocking admission, the stocks in the banking sector, already rattled by the collapse of two large banks in the past week, once again faced the wrath of the bears. European banks slid sharply in yesterday's session, including 6.8% drop in the US traded shares of Deutsche Bank. The move hit large US banks as well as shares of Wells Fargo and Goldman Sachs fell more than 3%. JP Morgan shed 4.7%, while Citigroup slid 5.4%. Interestingly, Indian banking stocks bucked the trend as Bank Nifty ended yesterday's session with relatively mild losses of 0.91%. Meanwhile, the index ended today's session in the green as well. Joining me in the newsroom is Karthik and my colleague Suyash. I want to come to you first. Suyash, at this point in time, the banking crisis is deepening, but as far as the stocks in the Indian market is concerned, the banking stocks specifically still ending the day in green.
Yes, that's the irony of the situation. We don't understand what's driving the confidence among Indian investors with regard to the banking sector. I think it's the proactive nature that RBI has taken, as we have seen in the cases of Yes Bank and other banks as well. So I think Karthik would like to add to it.
Absolutely. Karthik, the banking crisis is deepening in the US. What are the chances of a systemic failure?
Well, it depends on what part of the story one wants to listen to and who one wants to believe when it comes to this whole conspiracy theory about banking crisis in the US, all over the world, too big to fail, too big to save, it's all going to crash, it's all going to crumble down, there's a great recession coming up. I think there are a lot of angles to explore here. Specifically talking about Credit Suisse, there was obviously a shock across the banking world when we saw SVB go down and we saw Silvergate and we saw Signature. We saw that the confidence that the investors had in the banking sector of developed economies really shatter. And of course, everybody got reminiscent of the Lehman Brothers crisis of 2008, and it was being defined as the Lehman Moment for the banking sector as a whole. Now, let's try and understand what really happened at Credit Suisse. Very simply put, its largest investor, Saudi National Bank, did not want to exceed the 10% holding in Credit Suisse. Why? Because there would be a new set of regulations that would kick in as soon as the 10% mark got breached by Saudi National. So I think the real purpose of Saudi National not wanting to infuse more capital in Credit Suisse only stemmed from this regulatory perspective that it did not want to exceed its holding, which is at 9.8%, and take it to 10% and beyond. Fundamentally, and in fact, Credit Suisse has requested Saudi National Bank to issue a statement also formally in this regard. Fundamentally, Saudi National Bank has seen no issue with Credit Suisse. Now, there has been a knee-jerk reaction in the markets. India time yesterday evening around 5 o'clock, 6 o'clock, the story came to light. That's when the Switzerland SIX had opened, and we saw the shares of Credit Suisse tumble. They lost about 20-25%, went down, if I remember correctly, all the way to 30%. And this morning we are up 30%. So it's pretty much status quo. There was a blip and there was this crash and then a boom again. So multiple voices have come globally. Analysts globally are some of them are saying that it's too. So Nulliel Rubini, for example, has said it's too large to fail, but at the same time it's too large to also be safe. Now again, this statement came India time early morning today, and by then the markets had not opened and one did not see the spike back. And other JP Morgan and couple of other investment firms in the US are giving all kinds of theories, which are contrary to each other. But fundamentally, there doesn't seem to be a problem with Credit Suisse as we saw in the case of SVB. SVB was a completely different story where there was a bank run, and owing to the bank run, there was this massive selling of the stock, and people usually lost confidence in the bank's ability to sort of honor the demands that came to the bank. But fundamentally, Credit Suisse seems to be fairly all right, if you look at it dispassionately.
Okay. Karan Mehrishi, who's an economist, also joining us on the broadcast at this point. Karan, what's your take on what's happening with Credit Suisse?
Hi, thank you very much for having me. So I would like to take attention to the balance sheet of Credit Suisse. Now, the Credit Suisse balance sheet is about $700 billion. Now, that's almost 75% of the Swiss economy. So if you ask me, it will be very difficult for the Swiss central bank to sustain a collapse if it happens, unless it chooses to utilize the dollar swap lines it has with the US Fed and the euro swap lines it has with the ECB. And that is why the market is panicking right now. And you see that through the lens of the credit default swaps spiking at this point in time. So my sense is that the market is expecting that the mess will be very difficult to manage for the Swiss central bank alone. And the contagion, given the fact that so much exposure the bank's balance sheet has, when you talk about global assets, which also includes risky assets. And that is why we are seeing the current panic in the market, and the contagion can be hard to manage.
Right, Karan, but if you follow the story as it is developing right now, the shares have bounced back as well. A 50 billion Swiss franc loan has been issued by the Swiss central bank, and at the same time, that's equal to what, 53, 54 billion dollars, worth of a package. So, I mean, fundamentally, looking at the balance sheet, of course, I think every bank would have a certain exposure to debt. So fundamentally, is the story in the balance sheet of Credit Suisse any different from what it would be for any other large bank?
That is what I was actually alluding to. Given the fact that the balance sheet is so large as compared to the sovereign GDP, where the bank is headquartered, that is giving markets the jitters at this point in time, because now $700 billion worth of balance sheet. Now, if you look at the exposure of a global commercial bank like Credit Suisse, then it has exposure to several structured assets as well. Now, in a crisis, whenever a crisis begins, the first to fall are structured assets. Now, the same situation prevailed during the Lehman crisis as well, when suddenly, as interest rates normalized and monetary policy was affected to reduce systemic liquidity, the structured assets started to fail, and that created the domino effect that eventually collapsed the American and the Western European economy at that point in time. So that is the reason why the market is panicking right now. So it's not that the bank will fail. It's the fear that if it fails, what kind of domino effect it will have on the global financial system.
Right. So help us understand. You're an economist. So help us understand how much of a bailout could the ECB do in this case, considering the fact that Switzerland does not follow the same currency as the euro and has its own central bank. So what is the play between the ECB and the Swiss National Bank, central bank?
So, all these. So the U.S. Fed has a dollar swap line, and it includes certain systemically important central banks across the world. Now, the Swiss central bank is part of that system. So what that means is that whenever a crisis happens, then these central banks have access to dollar uh, at a predetermined rate, and they can pay back that dollar loan whenever they have stabilized, as soon as they've stabilized the system. The same arrangement is there with the European Central Bank as well. Now, as the bailout fund, as you mentioned, is concerned, then the Troubled Asset Rehabilitation Program, or TARP, which the Americans had instituted during the financial crisis, was worth around 700 to 800 billion dollars, and that was not fully utilized. So we can safely say that they will be using a number of tools, including a rehabilitation package, which the European Central Bank will initiate sooner or later, as well as the dollar and euro swap lines that the Swiss Central Bank will have access to from the US Fed and the ECB.
All right. But coming to, let's say, the fact about about the Indian stocks in the banking sector not really taking much of a hit, do you think this has to do with how robust our Indian banking system has become, especially since the government has come down so heavily on NPAs? Do you think our regulations and our overall structural reforms that have happened in the banking sector, is the Indian investor and the regulation in itself, has it sort of outshone the developed world in that sense? Have we been a little more ardent with and prudent with our regulatory framework in the banking space?
So the regulatory framework is strong. There are absolutely no questions about that. But to answer this question, I would like to draw your attention to the holding of government securities by Indian commercial banks. So on average, Indian commercial banks hold about the assets of a commercial bank in India on average holds around 21% as government securities. The global average is around 9%. So that gives a lot of comfort to the investor, because the high quality liquid assets of Indian central banks, of Indian commercial banks, are very strong, and that helps in the liquidity coverage ratio calculations. So given the fact that the exposure is not in corporate debt, and the treasury almost 95% holds government debt, which is basically risk-free, gives a lot of confidence to investors when it comes to Indian commercial banks. The same situation is not same for global commercial banks, because the treasuries are highly diversified, and they have exposure, as I was mentioning, to corporate debt as well.
All right, Karan, thanks very much for joining us with all those details.